A very good afternoon, everybody. Welcome to the April edition of Netra. The past week has been quite heavy, we'd all agree on that. It's hard to make sense of the news, whether good or bad, because honestly, everything feels so fleeting. There's no real sense of stability anymore, no clear way to predict how the world order might shift. We're seeing oil prices fall, tariffs rise, currencies swing, and markets stay volatile. Whether it's hitting the worst of the historical trends, or in some cases, even worse. Now, do we have answers to all of this? Honestly, no. But what we do have is a perspective. And that's what we hope to share with you today. But before we start, I'd like to mention as a note that on your screen there will be a question answers tab. So, through the course of the presentation, you can post your questions in the question answer tab and we'll collectively take them towards the end of the presentation. So, to start, I'll hand it over to Sahil. Over to you, Sahil.
Thank you, Pragati, and thank you everybody for joining in. So, as you all know, 5th of every month we release this report, and this time, we have tried to put it into three sections. First is about the trade war, which is ongoing. We'll talk about it. Second section is about a very brief one-slide section about India's per capita GDP growth, and we look at some numbers. And then we will talk about specifically about this cycle in terms of valuations, where we stand, and also at the end about capitulation. So the last section is fairly important, and I think from a cyclical perspective, it will give you a very important insight in terms of numbers. So I will start straight away, jump into the most important stuff that we are going to discuss today. So I will share my screen and the presentation. So as you know that this is a very brief report, and this webinar is eventually going to be put on YouTube. You'll be able to watch this even later. So first, let's start with trade war, and this is the first graph. We made this very similar graph even back in Feb, when we had first highlighted that there is a growing risk of a global trade war. And more or less that risk was materialized or realized on 2nd of April. Even before that, 5, 6 days before that, when US President had imposed tariffs on Canada and Mexico, we had commented that this is the first shot has been fired, and now this is sort of new repercussions are coming in. So this is the chart which shows the average rate on dutiable goods, or the average rate on all imports that the US has imposed as tariff over a very long period of time. The chart goes back to 1825. And as you can see, the black line is the focus line that we want to focus on, because that is the average on all imports. And before 2nd of April, before that date, it was expected that the US president is going to announce tariffs which will be close to 17 to 19%, where this black line is right now. You can see that. But eventually the announcement came, and the tariffs are close to about 29% weighted average. Now, the calculation may vary. A lot of people have calculated it as about 20 to 23%. Some have actually calculated upwards of 40%, but it depends on what weights that you use. If you use trade weights, then logically, this number will come up about 29%. So whichever way you calculate these tariffs, they are way too high than what markets were expecting them to be. And they are also way too high than the last such big event, which happened 100 years ago, which is the Smoot-Hawley Tariff Act of 1930. At that time, the rates were closer to about 20% on an average. This time, the rates are even higher. What does this mean? It's very difficult to draw parallels between 1930 and today. Although anecdotally and superficially, you can draw many parallels between the 1930s and today. For example, you had COVID in this century and a Spanish flu in that century. You had wars happening at that time, although those wars were too intense. Then there was a rise in protectionism even at that time, which is what we are seeing even today. So there are some parallels that you can draw, but it also had the Roaring Twenties, which more or less we had only maybe 4 or 5 years of, right? And that too a rebound, not really a roaring time. But so there are some parallels that you can draw. Key insight is that Smoot-Hawley Act which happened 100 years ago, was detrimental for global growth. And we will look at that number. When we look at what has happened now on 2nd of April, these tariffs are high, and they are too high to ignore, right? A lot of people have, seen these tariffs, and there are some myths going around. I'll try to address them, two or three, which I think are very important, but we'll try to tackle them. Second is that whenever tariffs war happen or this trade war happens, it can lead to a global slowdown. And I will tell you what are the reasons for a global slowdown, what could lead to a global slowdown. But let's look at where we are right now. When we look at the cycle, where we are in the cycle right now, that will be a good way to start to understand the impact of what is happening, right? So first, let's look at this graph on the right hand side. This shows you global growth. So look at 2018. So January 2018 was the first time when Donald Trump came and started imposing tariff, largely a trade war which happened between China and US at that time, with less retaliation from China, somewhat some retaliation. But you can see at that time, global growth was much stronger than what it is right now. Almost half of the globe right now is seeing manufacturing production in a recession, and global growth is also right now very weak in comparison to what it was in 2018. So the market's ability to withstand some of these troubles was stronger back in 2018. Right now, it's slightly weaker, right? Second thing is, which is again very, very important, that in 2018, it was largely a bilateral trade war. This time, tariffs have been applied on all countries in the world. Okay, so we will talk about it. That what does it mean? But if you go back in history and you look at the Smoot-Hawley Act, which I spoke about of 1930, and let's look at last time when they had applied such tariff, what had happened. You can see this red line, red arrow going down. So when Smoot-Hawley Act was implemented, you can see the merchandise trade balance of United States deteriorated completely, right? Over the next 5 years, there was a stark deterioration. Now, this could be an outcome of the Great Depression also. It's very difficult to judge sitting 100 years later, but there are certain texts, certain books which were written at the same time, which will tell you that uh, the tariff war of 1930 was a contributor. Now, there are two, three important things to remember and note down. One, when this tariff war began in 1930, when US implemented very high tariffs on other countries, specifically on Eurozone, the other countries also retaliated, right? And this is one learning that we should have today. Currently, what has happened is US has put down tariffs on almost everybody else in the world, all other countries. China has retaliated somewhat, but this retaliation hasn't really gone up in extent as of today, right? So think about this. For example, US says that on Chinese goods there is a 54% tariff. Now, when Chinese exporters send their merchandise exports to US, they face 54% tariff. But if they send their merchandise exports to, let's say, France or Brazil or any other country for that matter, India also, they face lower or no tariffs. So it makes sense for Chinese exporters to send their goods somewhere else, right? And the moment they do that, even the other country will be forced to erect a tariff wall. Otherwise, its own domestic industry will suffer, right? And that is the reason why the first shot that US has fired in this tariff war is just the beginning. If it is currently going to stay, then most other countries will not only fight the US, they will also fight with each other, right? Otherwise, their domestic industry can suffer. So last time when we presented this chart in Feb, we wrote that uh, trade wars are more harmful to markets and economy than wars which are fought with ammunition, right? And the reason is that if there is a global trade war, almost all countries, get involved in that. And as you can see, last time when this kind of high tariff wall was created, the global trade plunged from about $5.3 billion to about $1.8 billion, about 70% decline. It became one third of what it was earlier because import export virtually came to a standstill over time, right? So it was a big dampener. Also, a lot of people have seen and judged the trade war in the context of simplifying that yields will fall and dollar will fall. But if you go back to just 2018, you can see that during that trade war, dollar and yields both went up, right? Maybe it was a reflection of stronger economic growth at that point in time. We don't have any clue or causation to put it around. But why did I put this slide here is just to showcase that it's almost impossible to find these causation effects and directly link them to trade war. It's almost impossible. What will the currency do? Because it's too many variables going around. So, for example, the dollar strength does not rely only on what US is going to do, but also relies on what competition is going to do. So it's not very easy to find out what will be the outcome. What is easy is to know and have a few frame of references, right? And I will talk about a few myths which are probably going around, and I wrote an article about it, and I posted it on my wall also. So there are some myths which are going around that this is just a temporary phenomena. There is, of course, the US president will know that it's not a good idea to erect tariff walls, and he will roll it back, right? So this may be true, may not be true. We do not know. We've seen that historically, people do stupid things, and people in power end up taking decisions which are harmful. So there is no way to judge whether these will be rolled back or not. But let's assume that they are not rolled back for 1 month. The markets will not wait. It will not wait for that hope that it will be rolled back to turn to reality. It will continuously correct because it has to discount what is happening. So that price damage can be detrimental for investors, right? People who will take it lightly, they might face that consequence. So it is much more logical to focus on your asset allocation rather than focusing on how the tariff wall will evolve, right? Second is another frame of reference that people have, that because India has 26% tariff and other countries, for example, China is 54, so we are better off. So I think this is only half true. The reason is that tariff walls are not only important for the rate at which the tariff is imposed, they are more important because they cause a global slowdown, right? And that slowdown is the real effect of a tariff or a trade war, not just the rates. And once that happens, when global slowdown occurs, all countries get involved in it, and they all countries see a slowdown. And India is no different. And we've seen that in the past also, right? Many other past instances of DSP Netra, we've highlighted how this becomes very important. Another frame of reference is that because we've survived COVID or GFC, etc., this is nothing, right? And that is another way to think about it. Maybe that is also true, but it's important that our portfolios survive an onslaught, and it's better to be prepared rather than be completely out there. So I think risk controlled and conservative portfolio are much more logical unless stocks become cheap enough that any event does not matter, right? Let me put it that way. For example, let's assume that Indian stocks were trading at 15 times or below trailing earnings when this event occurred. Then you would not have paid it so much attention, right? Because the margin of safety was too high uh, to matter, right? But we are not trading in those at those multiples. We are trading at 20 time plus multiples across market capitalization, right? Therefore, it is very important to consider the margin of safety aspect very, very clearly. And I think there are three cases in which this can unfold. The best case is that if US rolls back the April 2 announcement and says that we are going to impose a month, 6 months or a 3 month or suspension on April 2nd tariff, and we will renegotiate. That is the best case that can happen. Whether it will happen or not, I have no clue. Second is, what is the most likely case, that US says that I'm going to do bilateral trade negotiations, which means that they will not remove the April 2nd tariffs, but they will talk to each country and create individual policies, which is a bilateral agreements. That I think will open doors for huge amount of volatility, because it will open the possibility of a slow and gradual trade war, right? Although it is better than the worst case scenario, which is the next one, but it still will provide more volatility to the market. It will be very difficult to find out who is the winner and who's the loser. The worst case scenario is that nothing happens and countries fight with each other erecting more tariffs. And I think right now we are in the third bucket, which is the situation is still evolving. We don't know how it pans out over the next few months. But one thing is very clear that this is an event which is of enormous importance uh, because it hinges on policy making and not on something that you and I can decide, right? And therefore, its impact will be known only in the future. How should the investors act, or how should you react? One, I think the if you want to invest today, use hybrid funds. They provide a much better way of expressing your view. If you are conservative, going to a DAF category or a multi-asset category makes a lot more sense. And I don't think we need to predict what will happen with the trade war, whether these tariffs will be removed or they will stay. I think that prediction should be left alone, and you should solely focus on your asset allocation and remain conservative unless stocks become cheap enough, right? And we'll look at where stocks will become cheap. We'll look at some data points which will guide us to that. So that was about the trade war. Maybe there will be some questions about it. We can take at the end. You can put your questions in the tab box in the Q&A tab. The second section is about India's per capita income trends. And so this is a often discussed topic, and a lot of people pay attention to how strong our growth rate is. So we looked at a number of other countries which have been able to move from $2,500 per capita income to $20,000 per capita income. So you can see the best case scenario is Japan. It took about 15 years, growing at 15% CAGR. On an average, countries which have been able to do this, move from 2,500 to 20,000, they have done it in about 21 years on an average, right? And the worst case scenario is South Korea, which took 23 years. When you look at India, our own best case right now, according to our own history, is about 8% or so, 7.8% or 8% or so. If we follow that path, it will take us 27 years, so about 2050. So there are a lot of numbers which go around that India will reach $20,000 in the next 10 years, 15 years, etc. The data tells us that even if you are able to do it, there are many countries which are not part of this study because, for example, in Indonesia, which could never reach $20,000, right? So if you add those countries, the averages will go up significantly. The number of years will. We are here saying that even if you follow the winners, on an average, it should take between 20 to 27 years to reach $20,000. And this is not a binary number. So no magic will happen at $20,000. In fact, even at 10 or 12 or 13,000 or $15,000 per capita, India will become fairly affluent, right? So don't make a mistake about thinking that 2,500 to 20,000 is the sweet spot. That is not the sweet spot. The journey itself will be very rewarding, but our understanding is current growth rates are slow and we need to accelerate these numbers. Where will the acceleration come from? Maybe is a topic that we will touch upon in the future versions. But to put these numbers out there so that all of us know what the growth rates are is very, very critical because 8% growth rate in dollar terms is still very hard to achieve. I don't think we've been able to achieve it for a very long period of time. If we do that, then possibly this is the path. When you look at the real numbers, our average growth rate per capita in dollar terms will be less than 6%, right? So it will take even longer for us to go to 20,000. But these are few of the cases that we put out here. Even 6% growth is excellent. It's a number very few countries have been able to do it because many could not even reach $20,000. So that is how you should contextualize India's growth. Fairly okay, not too fast when it comes to in comparison to other countries. And also, let me highlight one very important point. This does not consider any big lucky break that we'll get. For example, take the case of UAE. It went from about 2,000, 2,500 per capita income to $20,000 per capita income in a span of 4 years. And the reason was that they found oil, right? So we don't know whether we can find oil or some other lucky break that we can get in the future. Of course, we cannot predict it. If something like that happens, then this does not hold true. We can reach much faster, but those are lucky breaks that you can't really account for, right? The next section is how we are placed in this cycle, which is very, very important, and it will throw up a lot of numbers. First is we wanted to look at corporate India's balance sheet. And when you look at these trends, you will see that we've highlighted a number of years, 2003, which was sort of the worst phase for India, a full 4 5 year cycle where global economy was weak, Indian economy was weak. 2008, a very good cycle, almost 4 to 5 years of great economic boom and booming stock market also. 2013, again, very bad phase. 18, not so good, not so bad, a middling phase. And 24, again, a very strong 4 to 5 year bull market. So when you look at all these dates, you will find that in many instances, the balance sheet's strength, it ebbed and flowed, right? Sometimes it was strong, sometimes it was weak. But you can see in 2024, almost all sectors as of today are at their best, right? For example, let's say when you look at, let's say, real estate, the realty, uh, in 2008, it had the best balance sheet. This is debt to asset ratio, how much of assets are being financed using debt and vice versa. And you can see that currently it is at 34%, which is not as strong as real 2008, but in almost all other sectors you can see that we are at the best readings right now. So what does this mean? That in two very important and critical observations, in most bull markets, um, corporates become very, very complacent and they borrow a lot of money thinking that the future is going to be very bright. And what happens is a deterioration in balance sheets. So in bull markets, they become very, very confident about the future. They borrow a lot of money, do a lot of capex. This time, most corporates have been very shy in spending a lot of money. What they have done instead is clean up their act, clean up their balance sheets, which we think is a sort of a buffer. It is a good outcome to allow the corporate India to withstand a slowdown, right? It will allow them to take a hit of times when they are not so good and still survive, right? So it will probably be a very big positive for corporate India. But one thing is very clear that bull markets are not born on balance sheets, right? Strong balance sheets help you withstand bad times, right? So we look at what is happening with other parts of the P&L. Let's look at the profit growth. So when you look at earnings growth for different sectors, same sectors that I showed you in the last slide. So profits are driven by three factors: sales growth, margin expansion, and capital allocation, right? When you look at current, let's say last 5 years of earnings growth, you can see that we are just shy of 2008 cycle, where the median CAGR or total profit pool CAGR was about 27%. In 2024, it ended at 22%. So one of the strongest reading across any 5 year periods. And in fact, if you adjusted for one or two companies, uh, 2024 would be better than even 2008 in terms of earnings. One or two companies have contributed significantly in this phase, right? Uh, what does this mean? The compounding of profits at 22% is an aberration. It's not normal, right? So when you look at, let's say, India's GDP nominally grows at 10 11%, even export growth is not higher than that of companies which export outside. In fact, it is less than 10%. So in aggregate, profit growth is unlikely to be more than 10 11 or even at the best 12%. In cycles where it goes to 22%, 25%, etc., it's an aberration. Eventually, it will mean revert, right? Because think about this: if profit growth continues at 20, 25% and the GDP growth is just 10, 11%, there will come a time when profits will become bigger than GDP, which is mathematically impossible. And that is the reason why these numbers mean revert, they slow down. And we think that after the 2024 stellar show over the last 4 5 years, the profit pools have already started to slow down, right? We've seen the CAGR come down. We've highlighted in a number of reports since last year that quarterly numbers are not now growing at single digits, 4, 5, 7%, 10% in various cohorts. So we think earnings growth's best 4 5 year period is behind us. We will settle at a number which is, let's say, low double digits or close to high single digits. That is possible. We don't know the exact number, but that is where we will settle, right? That also tells you that it will be very, very hard for Indian markets to continue to trade at 20 time plus multiple. You can trade at 20 time plus multiple across market capitalization when your profit pool is growing at 20% plus CAGR. But when it doesn't, then it will be a very, very hard outcome, right? The next is, as I said, massive price growth. You can see that 2025, 30% CAGR is what we've seen. In 2008, it was 43% CAGR, the biggest bull market that we've ever seen. And prior to that, you can see in 2018 also we had 19% CAGR. These are different phases, right? But as you know, the longer term returns for the index is close to about 12 and a half, 13% in the last 25 years. If you take longer data, it comes down even further. So to continue this pace of 25, 30% CAGR or even 20% CAGR is going to be very, very hard, right? And just think about it that if bonds deliver 7, 8%, and stocks will not continue to deliver 25 to 30%. It's nearly impossible. So these cycles ebb and flow, and we've highlighted this even over the last 1 year that these numbers are too elevated based on where profit pools are moving, how fast they are moving, and how margins are contracting. It's very hard for prices to continue to compound at this number. And we think that currently we are seeing that normalization take place. Uh, it's very hard to foresee what will cause this slowdown, right? When the bull market is in full flow, it's nearly impossible to know what will be the reasons for the market to come down or profit growth to slow down. But markets will throw up reasons. So, for example, in the previous cycle, in we had global financial crisis. Then after 2018 cycle, we had COVID. In between, we had twin balance sheet problem, etc., etc. This time we have a new reason, the trade war, etc. Right? And so these reasons keep on coming, right? And that is the reason why markets go back to the long-term trajectory, both in terms of profit growth and price growth. The next is where the valuations are. So we spoke about the balance sheet in this section. Then we spoke about earnings growth. Then we spoke about price growth. Now we are talking about valuations. So what we did is we looked at different sectors, looked at different valuation metric. You can put many other valuation matrices, right? You can use other multiples also, but these are some fairly common multiples to use. They are not enough, they are not sufficient, but this is one way to look at it. You can be much more deeper and look at many other aspects. But when you look at these multiples, you will find that there is some value which has emerged or a lot of value which has emerged in private banks, but in most other sectors, it is absent. You can find some bargains in oil and gas or one or two stocks in pharma and chemicals, etc., or maybe one or two in auto. But it is very hard to find bargains in most sectors, right? So it is still not a very cheap market. And it tells you that you have to be really bottoms up to find value. And that too, a lot of value still resides in, let's say, a few sectors or in the large cap companies or the largest cap companies where you can find value, but it is not easy, right? So if you make the same tracker, let's say at the bottom of COVID or at the bottom of global financial crisis or at lows when the markets fall, you will find that mostly in most sectors, almost two-thirds of the companies become bargain buys. What do I mean by bargain? Uh, Take, for example, private banks. And let's say there are 10 private banks. What we have done is we have taken price to book for each of them. And versus their own history, where do they trade? Do they trade in the bottom 30 percentile valuation of their own history? That is how we've assigned. If they trade, then we count them. So, for example, this 70% number means if there are 10 private banks, seven of them trade in the bottom 30 percentile of valuation of their own respective history. So that means there are a lot of bargains in that sector, but it's very hard to find bargains elsewhere. Our sense is that we'll be able to find some more bargains as the markets progresses. And once this sheet becomes a lot more green, more sectors become green, it will be a very good time to allocate more to equity. Private banks, one other view that historically, whenever number of private banks, for example, 70% of private banks are trading in bottom 30 percentile of valuation, then the next, forward returns, 1 year forward returns are generally very, very high. So you can see that if black line is very high, the orange line catches up, right? and that is what probably is playing out even now. As you can see that when markets fall, this is a sector which falls lesser as compared to the market. And our sense is that once markets stabilize, this will be a large performer. Um, Next is that there has been a earnings cut which has already started in most market capitalization. Earning estimates are now getting cut. Earlier, earning estimates were being revised upwards. So in the previous many editions, we showed that it's becoming nearly clear that to grow at 15-20% will almost be impossible. You will be able to grow at maybe 10, 11, 12% in terms of earnings, but estimates were still very high. And now those estimates are getting cut, which means that the realization that earning growth is not very strong has started to seep in. And usually, this is the cycle which starts or sows the seed of a recovery eventually when market expectations become realistic or people begin to not find a lot more enthusiasm. Those are good times, but this is just the beginning where earnings cut have started. Even in US, cuts have started earlier. Earnings were expected to grow between 12 to 13% in US. Currently, those numbers have fallen to 8 to 9%. My guess is that they will fall to about 2 or 3% based on how we look at it. And our numbers will also fall to about 7, 8% or 5%. So these earning cuts um, tells you that the persistence of degrowth or a slowdown in earnings growth is going to persist for at least 2 to 3 quarters. And in the short term, it will weigh on stock prices or indices. Eventually, this becomes a very good contraindicator, but not yet. It is just the beginning of earnings cut across the world. And they also hinge on a lot of other events, right? But more or less, these earnings will slow down in the next few quarters, right? So this is very clear. Again, one's very similar chart which shows you that companies where PAT growth was more than 25%, which is a very healthy sign. You can see that it jumped significantly after COVID, and that number has now come down. So companies with very strong earnings growth, their number has started to fall, right? And companies where there is degrowth or contraction in profit, that they have started to report lower and lower profits or lower profits than last year, though the number of such companies is rising, right? So highly profitable or high profit growth companies, their number is falling. Companies where profit growth is contracting, their number is rising. So this is again one more depiction of what I showed you earlier, very similar to all these outcomes, where howsoever you slice and dice data, it will give you the same thing. That so let me sum up this section. Balance sheet strength is very strong, which gives you a sense that corporate India will be able to take the slowdown much more positively. That also is a good sign that on the downside, we'll be, let's say, we'll try and avoid a lot of accidents. Second, markets are unhinged for the last few quarters where earnings growth has slowed, but prices have not followed. They still continue to remain high. So as earning growth slow, valuations will contract, and that is what we are seeing right now. Once they reach a stage where they are average or below average, which we wrote in the last Netra report, you can go and read about it, where the markets will reach average valuations. Then I think using valuation as a metric to do asset allocation will be useless, and you can go back to average market valuations. The next section is very important, and we wrote it because it made a lot more sense to write about market capitulation. And what is capitulation? It is a response where investors panic and sell their stock holdings because they become very emotional. Either they become fearful because of, for example, like a COVID event or a Trump trade event, etc., and they do not buy or sell based on the intrinsic value of stocks, but based on their emotions. And that we think historically creates a lot more bargain opportunities or buying opportunities. So we'll talk about this section. We've put 7 slides on historically what are the signs of capitulation. How do we identify that markets have seen a capitulation? So this is the first slide which talks about the unsettling calm, right? So we've used this phrase last year also. Look at the chart on your screen, which is the Sensex chart, log chart, which is how it should be. You can see it rising from 1979 with intermittent period of no performance and some declines in 2008, etc. But it looks fairly good, right? Look at the lower panel. Lower panel gives you the day on day change. For example, if Sensex was up 2% today or down 3% yesterday, it will be depicted here. The up bars, which is above the black line, shows you that Sensex is up, and uh, the down bars shows you that the Sensex was down, right? So this is how it looks. I've just sort of magnified it a bit. Now you can see these orange bars in between. These orange bars are a change of more than 3% up or down. When it is up, it is +3, down is -3. And the green is ±5%, right? You can see that from about 1985 onwards, you can see there are a lot of green and oranges, right? Which means that markets were quite volatile, up and down, both ways. But you can see from about 2012, 13, 11, you started seeing less and less of orange and green. In fact, the green nearly went away. You had just about two or three 5% decline days uh, over more than a 12 or 13-year period, right? And similarly, even on the upside. So markets became fairly consistent, started to move around the mean. And what it does is it makes people believe that the market has become less volatile and sort of unhinged from reality. But if you make the same chart for a Dow Jones for 150 years, you will see that these phases come and go. This is what is called clustering, which means that volatility comes in clusters. Sometimes it is very high, and these periods go on for 10, 20 years, even more. And at other times it is low, for example, over the last 10, 12 years. But once it starts to go up, that means once volatility begins to rise, it remains like that for an elongated period of time. And that's why we've written here that the unsettling calm is broken, right? And that is what we mean, that there is a good likelihood that um, markets are seeing uh, more volatility than they have from versus the past, right? And this is a depiction of the same idea. And we believe that this unsettling calm is broken based not only on our domestic data, but even if you look at most other securities globally, they have started to depict behavior which is once in 20 years, once in 30 years, etc. Whether it is the bond market, whether it is the stock market, not only US, when you look at even other markets for that matter, Eurozone, China, currencies, etc. In many markets, we'll see this behavior getting replicated. Now, high volatility is a friend of the patient investor and the enemy of an impulsive investor, right? So if markets become more volatile, it gives more chances to the patient investors to go and invest at better prices. And those opportunities were very rare over the last 10, 12 years. If what we are saying is true, then there will be more opportunities. And as a patient investor, if you have the right asset allocation, if you have low risk assets in your portfolio, you will be able to allocate very quickly to stocks when they become cheaper. The next is VIX, which is a volatility index. What it measures is the implied volatility of, in this case, Nifty options. Now, when people go and buy options, they are expressing their uh, view, one view on volatility, or how much premium are they ready to pay for that option. Usually, people use Black and Scholes formula, but that formula more or less does not completely capture how markets move because it is based on normal distribution. But markets are much more wild than what they are. That's what we've shown in the chart below. If markets were to move according to the expectations of the Black and Scholes formula, the underlying logic of that formula, then having a 10% day minus or plus will be one in a billion year, even more than that, right? But that doesn't happen. It usually happens more often than not. Even 5% moves becomes extremely rare, but they often happen. It happened just yesterday. Markets opened 5% lower, right? And therefore, when VIX goes up, like it did yesterday, it went above 20%. We published this report on the 5th, but luckily we saw an event unfold very quickly where VIX went up above 20. So, which is a good learning for all of us, that how do these markets move? And that movement itself tells you that there is some amount of panic that is setting in among investors. Now, how does this panic set? When investors are ready to bid up option prices, regardless of at what cost they come. It shows you that they want to hedge their positions, or they want to take benefit of wild market moves. And how do my wild market moves happen? They happen when people don't judge the price of the underlying business, but they want to buy sell the security or the stock price, right? And that gives you possibility of lot of bargains which you can accumulate. So this is the reason why in most bear markets, VIX goes up. And if there is a bear market where implied volatility has not gone up, it could mean two things. One, that it is not a bear market, it is just an intermittent correction, or uh, eventually you will see a VIX spike or a implied volatility spike where people will become panic stricken, and they will offer bargains to the patient investor. So we believe that one of that event has occurred where VIX has gone up, and it highlights that that phase of capitulation may have started. In US, it went to about 50 plus. In India, it is just about 22, 23 at the peak. And it's very hard to know whether this is the peak or it will go even higher. Usually, we've seen it is a 2 to 3 step process. It goes up, comes down, then goes back up. That is how it has happened in the past, but there is no way to judge. The next is a 5% decline. So we looked at data from the last 30 years. In almost all instances where index has fallen more than 15%, there was a 5% minus day in all these corrections. Now, these are all random numbers. You could argue why not 16, why 15%, why not 20, why 15, and why not 5, why not 6, and why 5. You can put any number. What does it tell you? That large downside deviations in the market is again a reflection of capitulation or panic, where people sell stocks or any other security emotionally. It's an emotional response. In some market terminology, it is called a technical selling, not based on technical analysis, but based on factors which are over and beyond the businesses which are underlying the stock market. What does this mean? That when people come and see losses, they want to extricate themselves from markets and they are ready to sell at any price. And there are many instances in the past that it has happened. And when this happens, stock prices go back to below average or cheap valuations because the seller is forced to sell. And that is the time where very high future compounding begins. So, for example, go back to March 2020, a panic selling reaction. If you look at from that day, 5 year onwards, the CAGR is 25%, right? But if you pick a very normal day, some other date where there is no panic selling, the future CAGR will be much lower, right? And this is what I mean by capitulation, right? When people have an emotional response, and in this cycle, we are yet to see a minus 5% day close on close. For example, yesterday's market went down 5%, but they did not close 5% lower. In fact, they did not even close 3% lower. It was 2.95% or something, although 5 basis point does not matter much. But we are yet to see a 5% down day, which means that for example, if markets have already made a bottom, we have no way to know. If let's assume that they have already made a bottom, this will be the first time where a steep correction has happened without a 5% decline day Nifty. Uh, which is very rare. And if you do a combination where VIX spikes above 20, there is no such precedent of that happening in any previous cycle, which means that markets still have a potential to fall 5% on any single day, right? Which means that the volatility that you have seen um, is just the beginning of volatility. And that is why the slide number one told you that volatility comes in clusters. So if you put all these data points together, they point to the same thing. It is very hard to express in uh, so many words, but if you're able to follow the line of thought, all of them tell you the same thing, that A, volatility comes in clusters. Once it comes, it persists. There is a persistence bias of volatility, and there are certain outcomes. For example, a 5% declining day, it could be something else also. It could be 4 or 6 also. Because we have to express it somehow mathematically, we used 5%. It could be something else also. But that expression happens in almost all cycles. So that's why I have written the title here, that the market displays a regular irregularity, which means that market, when you look at it from a distance, is very irregular. but there is a regularity in these pattern. And what is that regularity? That these elevated volatility readings, they come back again and again. That is the only regularity. What will be the extent of that is not known, right? The next is the market breadth. Again, one of the favorite indicators that I've seen historically. Simply put, in most stock market bottoms, when you look at NSE 500, almost half of the constituents, so out of 500 stocks, 250 or more fall 50% from their 52-week high. So जो भी उनका peak बनता है, they fall nearly 50% from that level, which is at that point, the index usually becomes very light, valuations become normalized, and there are a lot of bargain opportunities available, a tremendous amount of bargain opportunities available. In this cycle, we have not reached that level. The median stock decline is about 35%, right? So there are still these milestones to be reached, and that will signal a complete capitulation. So we haven't reached that stage as of now. The next is the trading volume of small and mid cap stocks versus large cap. So in bull markets, the small and mid cap universe starts behaving like large cap. And in bear markets, investors worry that whether small and mid cap stocks will be a going concern or not. So let me rephrase it. In bear markets, many small cap company appears as if they will not be able to last, and they become very, very cheap. Investors don't want to buy them. In bull market, they are repriced as if they are as good as large caps. So this is the market emotion of greed and fear. It continues in each cycle, and that is a reflection. The trading volume is a reflection of what happens in each cycle. And as you can see in bull markets, you can see these peaks where the trading volume of small and mid cap stocks become as big as large caps in most uptrends. And when the markets correct, people flee from them, and their trading volumes fall as a percentage of large cap stocks. And we are yet to see that happen. And these numbers will become more apparent. As you see, when you update these numbers based on, let's say, daily or weekly numbers, you will see these lines progressing in that manner. And as I said, it's a regular irregularity. It's you can't pinpoint a day or a week where it will bottom out or peak out, but you can pinpoint the extremity. Where does it reach an extreme? That is the history will guide you. We are at the other end of the extreme where small and mid cap volumes are very high. They were much higher 6 months ago, started to come down, but still maybe in the 85th percentile, right? Next is the outperformance or underperformance. In most market bottoms or full capitulation, small caps underperform large caps by about 28% on a rolling basis, right? So 28.6% is the historical number. Again, this is the historical data. It does not have to hold true in the future. It is just dumb history. It could be minus 20 in the future or minus 15, or it could be minus 40 also. There is no way to judge. But one way to judge is that once you reach 28.6, at least you have done the worst of average of the worst period of the history. So it gives you a lot of margin of safety, right? We are not there yet. We are at about minus 5%. So which means that when if the markets correct more, or even if they have to rise from here, large caps would be much more preferred until this froth comes off, right? And the froth is also reflected in valuations. You can see we've presented this chart many times where mid and small cap valuations have been way too high. They've started to correct. They peaked at about 46 times in September 24. Now, with hindsight, we know they fell to 34 when markets corrected, went back to 39 when the markets had rebounded. Now they are again very close to 36 or so after the last 2-3 days of price moves. But the longer term average, as you can see, is about 19. So an investor who was sitting in 2007, for him, 20x, the median trailing 12-month P ratio of small and mid cap stocks was the highest. It was the extremity. What is 46 for us today was 20 for that investor, right? And you can see that numbers have gone up in 17, it went to 30, now it went to 46. So there is a very important way to think about it, that if you had data only till this point, then you would have never been able to capture this uptrend. Right? You would have exited much further, and that is the reason why using one single data point is very, very harmful, right? You can't use one single data point. That's why we highlight a number of factors, number of way to judge what we are seeing. So one important consideration is the earnings growth, and the second is ROE. So if your ROEs are high, let's say 20% plus, and earnings growth are 20-25%, market will justify a high multiple, even of 25 to 30 times. But as you know today, earnings growth has declined to 10% or so. ROEs are 14-15% for SMID. Justifying these valuations become extremely difficult. And that's why as close to average as possible will be a much more logical and high margin of safety period for all of us. So these were the 7 key observations, and you can read this. And I would suggest that this section is one of the most important sections because it rarely happens that you see all the capitulation signs in the market and study them when they are happening. It becomes a very useful tool for the future. So I would suggest that you read this section line by line and see what markets are doing. And to conclude, I think the most important aspect in what is going around is to be uh, have a very good asset allocation, to be conservatively placed in your asset allocation. When you look at the markets and you want to put money in equity, err on the side of large caps, go towards large cap rather than going towards other categories as of now. The time to allocate to other categories like small and mid caps or even thematics will come in the future when valuations become cheap. And the way to judge that cheapness will come from this section. You can read it. It will give you a number of clues on when it can happen. It will not give you an exact point. It is impossible to know exact price bottoms or where it will bottom, but it will give you where the margin of safety will come up.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.